Kia ora everyone. Today I'm going to give the presentation on financial analysis. My name is Archana Thakur and it is being submitted to my facilitator Swatantra. So as a rent, a place for a rent, license, salaries, you have to do, you need money for that. If you want to expand into the new market, go for a research and development, or you want to buy a new business, again for that, growth and expansion, you need money. Working capital. What does working capital mean? Working capital is the bridge between the payment you do to the supplier and the money you get from the customers. Debt management, if you are just doing any business, sometimes you need a loan, a debt, then you have to repay it, pay the interest or the principals. So what forever you need to manage that things. For that you need a financial strategy. Risk mitigation, you never know, for any reason, for any emergency, you should have some money with you. So in financial strategies, you really make it out that you have that amount for risk mitigation. Competitive edge, you really want to go forward, make a niche or make an impact in the market, grow in the market, you have to go for a talent hunt, you need an investment. For all that, you need good financial strategies, compliance to meet out the legal and tax obligations, investor returns, you have to pay dividends, share values and other things. In all these things, financial strategies helps us. Now I am going to share some information regarding financial ratio analysis. What is it actually? Financial ratio analysis is essential tools which helps in managing financials. How? What financial ratio does? It simplifies complex data. It means it convert the raw financial number into a meaningful matrices and assess performance, that how your company is going, your profitability, your profit, how efficiently you are managing everything, your liquidity. Compare trends, like compare with the competitors, compare with your previous performances. So it's time to time, year to year for comparison, you need that. Benchmark against peers. Benchmarks in the industry you are in, the company or with the competitors as well. Support decision making. It's when you are a manager, you want to really take a good decision, or if you are an investor or accreditors. For all these things, to take out the good decision, financial ratio analysis helps you to be there, so that you can have a well-informed decision. Key financial ratios and their uses. There are main four financial ratios: profitability ratios, liquidity, leverage means debt, and efficiency ratios. So I will not dig very much into it because it's a vast topic. But in a short, I would like to tell you that profitability ratio means where we use it to show how much profit you have earned per dollar sales, because it's in a ratio part, and that is the formula we use for it. So net income divided by revenue. For liquidity ratio, it is used for test the ability that whether you are able to cover that short-term obligations, and for that formula is current asset divided by your current liability, and then you get the liquidity ratios. Leverage ratios, debt to equity ratios. The formula of is this total debt divided by shareholder equity. And efficiency ratio, it actually indicates how well or how quick your inventory sales, because we all know how much inventory hold on or turnovers cost us. And My next topic is break-even analysis. What break-even analysis is? Break-even analysis is actually helps the company to figure out the point where their all revenue, total revenue is equal to total cost. So for that, to achieve that, we have a formula which is fixed cost divided by selling price minus variable cost per unit. Why do we need break-even use analysis or break-even point? Because it's actually helping making us good pricing strategies, that where how much amount or how much sale you need to cover that, to reach that point, and cost control where you can control your cost so that you can reach there faster, or risk assessment, is there anything which is lacking you behind, and capital versus labor intensive. When we talk about capital versus labor intensive, when you have a capital amount, it means you have a higher fixed cost, means your break-even analysis will come late or at a higher cost. But when you reach there, like for an example, I would say you have invested in a machines. You have bought a new machine, a big new machine, and you have invested a big amount in that. So because of that reason, to reach that break-even point, you will get more time because you have already invested a big amount in there. But once you have reached the break-even point, you will started getting profit. And when you go for a labor, then your labor break-even point is actually very much lower. Means you are not buying a machine and you are, for every unit there is labor, then you have to hire more labor if there are more units you are selling or producing. So there your break-even point is less, but even then you have to the growth will be slower later on. A financial tool, and when we use it, when we have to analyze revenue growth planning, that it is actually for the future plannings. It's forecasting tool. So if you are really looking for the future balance sheet, that how much sales has increased, or working capital estimation, so that you can calculate how much extra fund or capital you need, or quick financial projection, when you need to really estimate using all your previous ratios, okay, so how much you have to be there. Long-term decision. When we go for a long-term decisions in finance, it is three main points: debt versus equity finances. For equity, you know that you don't have any, no repayment obligations, and that is very much good for the startup, because then you can preserve the capital for you for other things. Debt, in debt, no doubt you get some rebate in your tax and all, but it increases the financial risk. Lease versus buy decisions. In leasing, it lower, when you have to invest, it's lower your cost, but flexibility when you have going for tech or some machines or the software, if you can easily upgrade it. And for buying is like when you buy something, it has become your property, you got the ownership which you don't get in the leasing, and it gives you profit for the long-term savings. Investment evaluation, compare expected versus required returns, mean how much excess return you will get from the performances. What I would recommend here for startups, you should prefer equity to avoid repayment pressure, because you have started and going through the debt, loan, repayment. High-tech industries should go for the lease, so that they can mitigate the risk of adolescence or outdated. Or investors who have a good amount of money can go for a positive alpha. Now we are talking, I'm going to share about some information, working capital management. Long-term loan and issues. Impact on working capital for the long-term loans. It increases current liabilities, where in the issuing sales, you just no direct impact on because you sell out some of your company's share. And for the cash flow, regular repayment reduce the cash flow because your from the profit, your debt, your principal is getting decreases. But in issuing shares, actually no repayment, so you can preserve your cash for other uses. Cost, interest expensive because annually you just pay 5 to 10% equivalences, and in issuing shares you can expect the dividends. Flexibility, conveyance may limit your capitals, but in issuing shares, full autonomy for policies. Financing and shareholder impacts, stable loan versus non-stable loans. Stable loans, like when we get the loan from the bank and other legal places, then they have standardized terms for everyone, doesn't matter who you are. And for the non-term table loan, these are customized loans. I mean, it can be customized according to the plan and everything. Table loan has lower interest, and non-table actually you pay a higher interest for that. They have a strict rules and regulation we have to follow, but here you can be flexible with the condition. And they have a share types, ordinary shares, preference shares, dilutions and dividends. Restrictive convenience, what I mean by that, means like loan condition, limited borrowers, these actions like taking extra debt, paying dividends, because they really want to protect the lenders so that they would not waste their money and to preserve their amount they have given for the loan. Here, debts versus equity impact. We know in debt, financial risk is higher, where in equity, you lose your ownership somewhere. And here, the debt, you have a tax shield because you save in the text. But in equity, you have a benefit again that you need not to be in the pressure of the repayment. And it's may lower credit rating because you are already taking over, so your credit rate goes down. But here, it's may dilute your EPS. That's all with all the presentation. And now I am welcome if you have any questions for me.
Here your question, Archana. Just write down the figures and solve it for us, please.
Yeah, sure. Thank you. Okay, I have been given a question about an XYZ Enterprises, building a single product with the following cost structure, and I have to take out the break-even point units. Okay. So the formula for the break-even point is your fixed cost divided by sale price per unit minus variable cost per unit. And here the fixed cost per year is 40,000. Selling price I have been given is 50, and the variable price is equal to 30. So calculate this. What I will do, fixed into divided by 30 means 2,000 units. After 2,000 units, we will reach to that break-even points.
Yeah, it's all correct.